We do believe it's going to go into a complete free fall, much like we saw in oil back in 2008, that could push the Dow as low as 5,000.
And that's an incredible plunge from where we are now.
It only takes a handful of hedge funds to get a margin call before we start seeing this free fall take place.
Well, that was last week. We've got a new week and a chance to continue that conversation. Back with us on the Newsline, David Hefty, the man you just saw there, CEO of Cornerstone Wealth Management. He's calling for Dow 5. And Jim Hardesty. Last week he said no. President of Hardesty Capital Management. They're back, and good to have both of you with us. Okay, so that was a small part of our conversation last week. Today, it's all of the conversation. David Hefty, make your case. Why is it all you need is a couple of hedge funds to cause that sort of a downdraft, which would be a decline of 50%?
Well, again, when you look at the market and you look at the fact that we have $17 trillion of leverage inside the financial system, when you look at debt around the world, our particular financial system has more debt than anything else. It only takes a few hedge funds to get that margin call. When they start to sell, and the fact that everybody's already on pins and needles, that's where that free fall starts to take place. Again, just like what we saw in oil back in '08.
All right, Jim Hardesty, fight back. Why is this insanity?
Well, first off, we also have a significant number of assets supporting that debt level he cited, namely about $54 billion. So, I mean, we are, in a leverage sense, not that exposed. I also feel that the economy is in a sharp recovery phase now, and that it's supporting the valuations that we have. To go to $5,000 on Dow would mean that the value of Dow relative to the GDP would be 20% lower than the bottom of 1974. It would be 15% lower than it was in March of 2009.
Okay.
I just don't think this is going to happen.
Let me just interrupt here. Jim, as I understand, David's argument isn't that it would drop to that level on fundamental value, but rather in some sort of panic snowball trading effect. And given what happened with that 1,000-point flash crash, I agree with you. I don't think it's going down there, but you do kind of have to consider the possibility, do you not?
Well, I think there will be circuit breakers put in pretty quickly to prevent a repeat of May the 6th. That was an unusual event, I have to admit to you, but this is not likely to happen.
All right, David, a cynic might say, you know what, you're just trying to cash in on that flash crash with an outrageous prediction to get attention.
Yeah, no, here's the thing. To have an objective view, you have to understand where you are in the cycle. We're in the 11th year of a secular bear market. And when you look at these types of markets, we are still deflating or deleveraging the big bubble that started back in 1994. So as you start to look at those trends and where things are going, it still has a long ways to go. The fact of the 5,000, that particular piece, is very likely, and actually that's not even our extreme low when we look at our objectives that we look at and should make these determinations. So the most important thing investors need to do right now, though, that's the main focus. When you look at an investor, you have to either identify whether you want to continue to buy and hold and try to ride this wave up, or if you want to advance your money when you can, protect when you can't. The upside potential of the market after this next rally, because keep in mind, we're still full in right now. Right. We're very bullish in the short term. There's a rally that's coming. Once you get through that next rally and we form that major top, you have to decide how much risk you want to take, because the downside far outweighs the upside potential.
All right, David, listen, if you change your mind, you better let us know, because right now we're penciling you in for January when we can say, how dumb was that?
Yeah, I'll see
you hope how dumb.
David Hefty, Jim Hardesty, thank you both very much.